Hello friends, today in this video we are going to discuss about CA Intermediate May 2019 paper number 1 accounting. Here in this video we are going to do a brief analysis of this particular paper, like how the paper was, the difficulty level and all. So without wasting much time, let's start the discussion. First, question number 1. Now this question is compulsory. We know very well nowadays ICAI has fixed the pattern. They're asking accounting 1 paper as first question is compulsory, that will be for 20 marks, and they ask another 5 questions of 20 marks each. Out of that, a student is required to solve any 4 questions, so that comes to 80 marks plus question number 1 compulsory 20 marks, so 100. Now in this question number 1, nowadays they are asking questions on accounting standard. In this exam also they have asked question on accounting standard. This particular question number 1 is divided into sub questions, 4 sub questions of 5 marks. If we discuss sub question A, this sub question A is on accounting standard 16. My dear friends, we know very well accounting standard 16 is on borrowing cost. In this question, ICAI has provided different borrowings. At the same time, they have given different dates. So here you are supposed to be calculate the amount that you are supposed to be capitalized and the amount that you will be writing as an expenditure as interest in your profit and loss account. So the main important thing here is dates. They have given different dates, so don't make any mistake while calculating your capitalization amount. At the same time, here rate, you are supposed, as different borrowings are given, you are supposed to calculate weighted average rate, and then you find out the amount, how much it will be capitalized and how much it should be treated as a revenue expenditure, and we are supposed to give one small journal entry, and that's done. The next sub question in question number 1, sub question number B, that is on accounting standard 13, investment. This is very important accounting standard because in chapter also we have a separate topic, investment accounting. So this accounting standard helps in the theoretical questions of accounting standards as well as the practical question or investment accounting. Now ICAI has asked 4 sub questions in this, and all sub questions are on reclassification. Now reclassification, whenever we do, there can be 2 types of reclassification. One is long-term investment. Now as we don't want to hold it for a longer period, then we convert it into short term, or rather say we can say reclassify into short term investment. Sometimes we might have made investment for short term purpose, but now we would like to keep it for a longer period, so we reclassify it into a long term investment. Now what the rule is, so if we say when current investment is reclassified as long-term investment, then the rule is the investment is valued at cost or fair market value. As on the date of transfer. As on the date of transfer, whichever is lower. When we are reclassifying long-term investment into current investment, then the rule here is it should be valued at cost or carrying amount as on the date of transfer, whichever is lower. Now if you see here, the first question what they have given is, in that they have asked us to reclassify long-term investment into current investment. So long-term investment is having cost of 14 lakh rupees, which was written down by 2 lakh rupees. So right now we can say it is carried in our books at rupees 12 lakh. And the cost is rupees 14 lakh. So here if we apply same rule, the cost is here 14 lakh and carrying amount is 12 lakh, whichever is lower, so it should be valued at 12 lakh rupees. Then second case, the same thing is given, that the investment, again it was long-term investment and we are supposed to reclassify to current investment. So the cost here, it was 7 lakh rupees. The cost here, it was 7 lakh rupees, and they have given the fair market value, which is completely irrelevant. Here the written down value, the carrying amount is rupees 5 lakh. So obviously here we will reclassify it as rupees 5 lakh. The next sub point they have given, we are supposed to reclassify current investment into long-term investment. The rule here is it should be valued at cost or fair market value, whichever is lower, but most important you should focus on the word transfer, as on the rate of transfer. So here the current investment was purchased for 7 lakh, so my cost price is 7 lakh and it should be reclassified as long-term. Then on that day, the fair market value on 15th of June, the date of reclassification, it is 8.5. So 7 or 8.5, whichever is low, it should be valued at 7 lakh rupees. And the same rule applies to the fourth sub point, that the current investment, it was purchased for rupees 4 lakh. So the cost price here, instead of 7 now, the last part, it's 4 lakh rupees. And the fair market value, now they have given 2 dates. Out of that, 31st December is completely irrelevant because we are not reclassifying on that date. So on 15th of June, it's 3.8 lakh, whichever is lower. So we should be valued at 3.8 lakh and not 4 lakh rupees. Now, moving forward, the next question, sub question number C. Now you can see the magic of ICAI. They have covered all the accounting standards. They have asked true or false, and if a student has not read all the accounting standard in depth by taking into consideration the minor effect of that, then he'll fail to answer this. First one is for AS5. According to AS5, what the question they have asked is, extraordinary item should not be disclosed. Now we know very well, if we have read the profit and loss statement, then there also net profit or loss for the period includes extraordinary item. They have said it is not included, so my first answer is false. Then second one, in this second one is of accounting standard 12, government grants. In question they have asked that government grants in the nature of promoters contribution which become refundable should be reduced from capital reserve. It's quite obvious, because whenever we are getting some promoters contribution grant, then we credit it to capital reserve, we should reverse it. Moving towards next one, the third one is our favorite accounting standard 2, inventories. Inventory should be valued at lower of cost and selling price. Obviously not. Inventory should be valued at cost or net realizable value, whichever is lower. That we have already studied. You must have studied in your CA foundation or CPT in inventory topic. So here also the same thing is repeated. There is a huge difference between selling price and net realizable value. So it should be not selling price but net realizable value. Moving towards the next one, it's again for AS 13. Current investment is investment that is by its nature readily realizable and it's intended to be held for not more than 6 months. It is for 12 months. It is for 12 months, not 6 months. If you have written this answer wrong, you may get another 6 months. That's for sure. Next, fifth one. As per AS4, contingency is a condition or situation, the ultimate outcome of which gain or loss will be known or determined only on the occurrence of one or more uncertain events. Quite true. one or more uncertain event. Contingency is nothing but with the event which is dependent upon happening or non-happening of some uncertain future event which is not within the control of an enterprise. So this is true. Next question number D. In that they have asked entire question on accounting standard 4, but again not like a traditional question, but they have again asked some sub points. They have asked total 5 points in this, and you are supposed to discuss whether these events are adjusting events or non-adjusting events. We know very well adjusting or non-adjusting events are nothing but event occurring after balance sheet dates and before the accounts are approved by the approving authority. So here if you check, the balance sheet date they have given is on 31st March, whereas the the approving authority, they have approved it on 15th of July. So if any significant event which is a confirmation on condition existing on 31st of March are known as adjusting event, but if any event take place after 15th of July, obviously it is non-adjusting event. At the same time, if any event is taking place between these two, it is event occurring after balance sheet date, and if conditions are not prevailing on this date, we cannot adjust. Obviously once accounts are approved, you cannot adjust any events. So in first case, one case has been filed by another company on 20 April, obviously 20 April, so it's after balance sheet date. So on this date conditions were not prevailing, it is non-adjusting event. Then second one, the terms and condition of acquisition of business of another company have been decided by March 8. So terms and conditions for acquisition was decided, but the payment was made on April 15. So if the agreement is not made, then it is non-adjusting event. Merely if you have discussed the terms and condition, but then if the negotiation is going on, then it is non-adjusting event. But if the conditions are confirmed and agreement is done, then we can say it's an adjusting event. Then there's a theft of 5 lakh. Now this is very important, a tricky question. 5 lakh rupees was stolen before 31st of March, on 31st of March, but it came to our knowledge on 16th of July. Even though it pertains to this particular period, but it is non-adjusting in nature. The reason being, we came to know after the accounts were approved. Next is the immovable property. There is a proposal. Mind well, we have just received a proposal. So unless otherwise any sufficient or significant activities has been done, then it's still a non-adjusting event. Then a fire has damaged major part of property on 5th of April, but there was no condition existing that we were not in a position to know that fire will occur on 5th of April. So this will also be a non-adjusting event. So all 5, you can say it's almost non-adjusting. The next question that we have is question number 2A. In question number 2, we have 2 questions, A and B, both are of 10 mark each. Question number 2A is particularly on hire purchase. ICAI has already asked this question, this type of question multiple times, wherein a student is required to calculate cash price of the particular asset, and they must have specified few installments, and one of the installment hire purchaser fails to pay, and on that seller will repossess either one or more than one or maybe all the higher assets. In this question, first of all, in order to solve this, you are supposed to calculate cash price. We do have reverse working mechanism wherein we take closing outstanding of the principal amount and the installment paid divided by 100 plus rate of interest multiplied by 100. If you keep on using this formula, you get to know the opening outstanding cash price. Once you get the opening outstanding cash price of first installment, you simply have to add into it your down payment, and you'll get the total purchase price, or they say total cash price of entire asset. You keep on doing for first 3 years, first year, second year, third year, till the time the default is taken place. Now in that particular thing, hire vendor is repossessing 2 scooters and he is keeping remaining 4 scooters with him. Now in this particular case, you are supposed to provide depreciation till the end of third year and calculate the proportionate value of those two scooters repurchased by the hire vendor. At the same time, we have to do a separate working on the agreed value, or which is sometimes also known as repurchased value. So on that repurchased, how to calculate repurchased value, the mechanism is already given in the question, that we are supposed to calculate the agreed value at the rate 30%. You apply 30% for 3 years, you'll get the agreed value, and the difference between agreed value and your book value is your loss on surrender. At the same time, if you, on the contrary, if you think from the perspective of hire vendor, then the repurchased value, agreed value, is the cost for him. On that, he'll be adding the repairing expenditure and repair expense plus the repurchased value minus your selling price 1,05,000 will give you profit. This, I think, will be very easy, and majority student must have opt for this particular question, because here you can encash your marks. The next question we have is 2B, second part of question number 2, which they have asked from insurance claim. From insurance claim, they have asked very basic kind of question this time for 10 marks. So obviously student must have been very happy on seeing this particular question, where they don't have to do anything except following few steps. They'll be finding out GP ratio, which is sometimes also known as agreed GP ratio, by using formula insured standing charges plus net profit divided by turnover of last accounting year multiply by 100. Then you find short sales, and with the help of, in short sales, we use our standard turnover adjusted by turnover, trend in turnover, which is clearly given in the question, and actual turnover. Then third one is the gross profit that you have lost, which is nothing but simply multiplication of these two. Then the fourth step that we do is for calculating increased cost of workings. We have done some additional charges, and insurance company generally pay for that additional charges, but not straight away. We have to use some formulas and all that. So for that, we do a net claim for increased cost of working or additional expenses, increased cost of working. And the final step, by using your average clause, we calculate amount of claim. So in short, this was very simple. Many students might have made some calculation mistake in sheer excitement, but that we can't help. Next question that we have is question 3A. Even in question 3, we have two subparts, A and B. Question A is from incomplete records, which is also known as single entry, and it is for 12 marks. Here in single entry, they have asked a full-fledged question of final account, or which is also known as conversion method. Here you are supposed to prepare trading, P&L and balance sheet, trading account, profit and loss account, and balance sheet for that particular year. They have given information of opening as well as closing balances of certain transactions, certain accounts. Now you have to compare that whether there is any change in opening, closing or not. If you observe here, land and building don't have any change. Land and building is constant throughout the year, so we can assume there is no addition or deduction in that. Similarly, plant and machinery have some change, office expense has some change. Debtor account, generally we all prefer to open debtor and creditor account, because from debtors we can find various informations like closing balance, opening balance of debtor, credit sales, amount collected from debtors. Similarly, from creditors also we get to know many information. And in this question, we have to prepare creditor for sure, because they have not given the closing balance. Then provision for expenses is nothing but the outstanding expenses. Stock, opening stock they have not given, so this is very important. Then long-term borrowing, so borrowing in that they have given opening and closing, but there's a difference of 12,500, so we can assume that this must have been paid. Then different additional informations are given, collections they have given, so obviously it will affect your bank and debtors. Simply double entry you have to pass. Then next, the most important thing here is the GP ratio, which is on cost. My dear friends, we cannot use GP ratio on cost to multiply with sales, so we have to convert this into sales. This is 25% on cost, so mathematically it will be 20% on sales. In this question, if you check, they have given total sales directly. They have also given hint for finding out total purchases. So you know purchases, you know sales, you know closing stock, you can find out GP, and difference is your opening stock. Then various other information, no typical adjustment, discount received, discount allowed, bad dates, all such informations they have given. The difficult adjustment, what I find that many students will make mistake, or they must have made mistake, is the information on plant and machinery and office equipments. So they have given that firm has sold some office plant and machinery, and they have also purchased new. So here you have to apply the concept of proportionate depreciation. You have to give effect of profit loss, and you find the amount of additional purchase. Then office equipment is already sold, so that typical adjustment. Rest is fine. So this question I feel is bit lengthy, but if anyone has made a mistake of preparing opening balance sheet, then obviously they will be in trouble, and I assume they must not be in a position to complete the paper. The next question that we have is question number 3B from branch accounting. They have asked this question for 8 marks, and it's very easy question. Only you have to do simple conversion and that you're done. Now this foreign branch, we know very well in that we have two type of foreign branch. One is integral operation and non-integral. This question they have clearly mentioned it is integral foreign operation. So many students, they make mistake of converting it in integral foreign operation. How we do? Opening stock they have given, so that we convert on average, opening conversion rate. Then purchase and sales, as it is for throughout the year, purchase and sales we convert by applying average conversion rate. The next item they have given is your debtors and creditors, as this is a closing item, so this is closing conversion rate we apply. Bills of exchange, so bills obviously it's a balance sheet item, revenue item, so closing conversion rate we should apply. Wages, we apply average conversion rate. Then we have rent, here also we apply average conversion rate. Then sundry expenses, again we apply average conversion rate. Then computers, now mind well, for computers no conversion rate will be applied, because in question they have clearly given that information. For purchasing computer we have received money from our head, that should not be converted by applying any rate, but we should take the same amount and we depreciate accordingly. Then bank balance, obviously closing conversion rate. And head office, we will not convert it. Whatever balance of our branch is there in the books of head office, will take it. Then whatever difference is coming, simply we adjust it and we're done. So I don't think anyone will miss even a single mark in this. It's purely a cash mark. Question number 4. In entire paper, this is the only question which they have asked solely for 20 marks, and it is based on chapter partnership. Once you have a look at this question, it's quite possible that you may get scared, but my dear friends, there is no requirement of getting scared, because this question is really very easy. No doubt it contains admission as well as sale, but sale part is very less in that. So whatever we have done in admission at CA foundation level, only the same concept, same fundas we have to apply, just like valuation of goodwill, then gaining ratio, sacrificing ratio, etc. And then goodwill is not to be shown, so goodwill is to be distributed among the partners in their profit, sacrificing ratio. So it's very easy. And then you're supposed to prepare trading profit and loss, the entire financial statement, final account rather say, trading, P&L and balance sheet for that particular 1 year, and at the end of the year the business is sold, so and the capital you have to make in proportion. So it's not that difficult. Yes, I do admit it's really very lengthy, so those who have opted for this, they might have faced shortage of time. Not that difficult. The next question that we have is question number 5A, redemption of preference shares. Again, this is one good news that they've asked this question for 10 mark. In this you don't have to do anything, simply they've asked to calculate redemption value, so we need to calculate amount payable to preference shareholders. This question is almost similar to the question they have given in study material. So amount payable to preference shareholder, obviously including premium. They've asked to keep some minimum balance, so whatever amount is payable to preference shareholder plus minimum balance, this is the required cash balance. How they have arranged this, whatever cash balance is required, from that whatever bank balance we already have, so for that we don't have to worry. Then we have sale of investment. In order to meet the financial requirement, we have sold some investment. Now the balancing amount is supposed to be fulfilled by way of issuing equity shares. How we are issuing equity shares? We are issuing equity shares at premium. So in order to find out number of shares, we divide it by issue price and you will get number of shares. So this will solve your problem of the amount. Next, here in the same question we are supposed to calculate is requirement of Companies Act to create CRR. Now my dear friends, we know very well that in order to create capital redemption reserve, we use only free reserves. Here the amount equivalent to redeemable preference shares, the face value, we either transfer to CRR or we go for fresh issue of share capital. Fresh issue of share capital. In this question here we can see here we have issued fresh shares, so if you multiply it by face value, we'll get the amount that we have raised by way of issue of share capital. Remaining amount we transfer to CRR. That's as simple. We give few journal entries and your 10 marks is done. The next question that we have is question 5b, which is based on cash flow statement, accounting standard 3 revised. The sum demands solution by direct as well as indirect method. When you calculate the sum, you will get cash flow from operating activity rupees 2,30,000, cash flow from investing activity rupees 4,70,000, and cash flow from financing activity negative rupees 45,000. You have to be very careful in solving this. There are 100% chances you may make mistake in some of the calculation. Now closing balance of cash and cash equivalent is rupees 8,80,000. When you solve this question carefully, you have to get this 8,80,000. For indirect method, first we compute retained earnings and then after we compute cash flow from operating activity, and here in this case retained earning you will get 2,10,000 rupees. The next question is question number 6a. Question number 6 is having 5 problems. Out of 5 options you are supposed to do any 4. Each contains 5 marks. The first one is a theory one, which is based on accounting standard 22, taxes on income, and the very basic question that they have asked, that what is the difference between timing difference and permanent difference. So we know very well that in accounting and taxation we have different logic, and in accounting we do provisions and all, but which may or may not be allowable as per Income Tax Act. So we do have different mechanism in Income Tax Act. So because of that we may have certain differences called timing differences and permanent differences. On that you're supposed to write a brief short note. I guess that's very easy. The next question we have is question number 6b. Again, one more question on accounting standard. We have accounting standard 1. According to that, we have 3 fundamental accounting assumptions. One of the assumption is going concern. Students should note in this particular question that they have asked us to prepare profit and loss account and balance sheet, not assuming going concern. So we can say whatever amount we are taking into consideration, we should consider as if the business is not going to be continued, and everything should be recorded at a realizable value. So it's very easy. You have to just fill in the blanks and you're done with this. The next question that we have, question number 6C, it is based on profit and loss prior to incorporation. Very easy and basic question. They have already given you turnover ratio, they have already given you time ratio, so no need to worry about it. And they have given certain expenditure, director expenses, so you'll transfer to post incorporation. Bad date you will transfer in turnover ratio because it is related to turnover. Advertisement, many students can make mistake here because advertisement is generated to sales, but in this particular question they have already given a time ratio. Then company audit fee, obviously it should be transferred to post incorporation. Tax audit fee, it is related to turnover, and that's it. So you divide everything into pre and post, and you will get pre-incorporation profit and post-incorporation profit. And they also ask a theory question how to treat it. That's very easy. So you can also easily get 5 out of 5 in this. Question number 6D is again a theory question based on Garner versus Murray rule, where it is not applicable. So I guess in the beginning of partnership we must have read where it is applicable, where it is not applicable, so we are not wasting much time in discussing this. It's very simple. You just have to point out 3 to 4 or around 5 points and you'll get 5 out of 5 for sure. The next question that we have is question number 6E. Again, one of the accounting standard question. It is based on accounting standard 2, valuation of inventory. Here you are supposed to calculate normal cost of production based on normal output. So the entire question talks about the treatment of normal and abnormal output. So the total cost is divided by normal output, and whatever you get is normal cost of production. Any wastage in excess of normal loss is treated as abnormal loss, and the question talks about how to deal with that. So if we have any recovery of this abnormal loss, we deduct from that cost, and the remaining amount we transfer to P&L. That's it. So it's very easy. Multiple times they've asked this question. You can refer ICI study material for that. Here also you'll get 5 out of 5. So guys, this was all about today's paper, a brief discussion, small analysis, and this is what you should have written in your exam. But even if you have not written like this, it's completely fine. We have still another 7 papers to go. Another 700 marks are waiting for you guys, so don't worry and be prepared for the next battle. Thank you.